Thank you all for being here. I'm Bruce Walker, and it is my good fortune, even during these difficult financial times, to serve as Dean of the Robert J. Trulaske Senior College of Business. We really appreciate your being here for the Tom and Betty Scott CEO Forum. The college is very fortunate to be able to bring you these lectures through the generous sponsorship of Tom and Betty Scott, who are here with us this afternoon. Just a couple notes about them. There's more notes in your program, which I trust all of you have. But after graduating from MU's business school, Tom had a very successful career in insurance that lasted more than 40 years. Betty, who went to MU's School of Nursing, served as office manager for a group of Kansas City doctors for 40 years. Betty and Tom's portrait hangs in Cornell Hall on the second floor landing, along with the portraits of other very generous supporters of our college. Tom and Betty, would you stand, please, so we can applaud you? Yeah, thank you. They have an impeccable attendance record at these forums, and we're pleased about that. You know, the Trulaske College places a very high priority on collaboration with alumni, with the business community, and with our academic colleagues. The Scott CEO Forum, this particular forum, featuring the CEO of a very large Missouri-based firm, is one way in which our college seeks to fulfill its educational mission through collaboration. Now, before I introduce today's speaker, I'll give you two reminders. Number one, in fact, I should probably do that, check to make sure your cell phone is turned off. And number two, I'd ask that you stay through the end of the program, which will include questions and answers, and we'll give you the assurance that we have you out of here by about 4:45. At this time, it's both a pleasure and an honor for me to introduce our Scott CEO Forum speaker, Jim Weddle. Mr. Weddle is the managing partner of Edward Jones, a leading financial services company with over 7 million clients. Edward Jones employs more than 40,000 people and has over 10,000 offices across the United States, Canada, and the United Kingdom. Just weeks ago, Fortune magazine ranked Edward Jones second in its annual list of the 100 best companies to work for. That's really high praise. And I hope Mr. Weddle will talk about the expansion of the company's headquarters in Maryland Heights, as well as its hiring plans. Mr. Weddle's bio in the program gives you some details, so I'll be brief. I'll note that he graduated from DePaul University and later earned an MBA degree from Washington University. He began his career with Edward Jones in 1976 by opening the firm's 200th branch in Connorsville, Indiana. Over the following 30 years, he held a variety of positions within the company, including responsibility for the firm's growth along the East Coast. Mr. Weddle assumed his current position in 2006 when he became only the 5th leader in Edward Jones' 86-year history. By the way, this is the first time we have had a second Scott CEO Forum talk by the CEO of the same company. John Bachman, having done this talk, presented this talk during the 2001-2002 academic year. So much has changed since then, to be sure. Today, Mr. Weddle will describe what can or might be learned from the recent economic downturn and how to benefit from it. Don't we need that type of guidance? And you can see, I believe, the title of Mr. Weddle's talk on the screen, and I think he may even give you a subtitle for it, or an alternate title for the talk. Actually, you've got it on the front of the program. What the heck happened and how are we going to get through it? So, ladies and gentlemen, please welcome Jim Weddle.
Well, good afternoon. Good afternoon. I know it's late. We're going to be a high-energy group today. Thank you very much for the opportunity. This is very special. We have a great relationship with your university. We have enjoyed the opportunity to recruit and hire folks from the University of Missouri for a long, long time, and it's just worked out so very well for us, and I think for the school as well. At Edward Jones, we've always been impressed by the quality of the students. Great educations. They're can-do, they're focused, and many are making very, very large contributions to our success today. As was mentioned, lessons of the 2008 market crash, and what do we do now? I don't have all the answers for you. I've got some observations, I've got some suggestions, perhaps some general guidance. Investing is a very individualized kind of an endeavor. No one shares the exact same investment objective with someone else. So you need to be careful. You need to get customized advice, and we think at Edward Jones it's what we're good at. Let me talk a little bit about our firm, give you an explanation of who we are, who we work with, what we do, importantly, what we don't do, because we think that's important to understand and to not lose sight of. Give you a little bit of a survival guide for the current mess, and believe you me, it's a mess. We've got some major problems right now. I also believe that we can work through each and every one of them. Then at the end of my comments, I would love to take your questions. Anything that you'd like to talk about. If I don't have the answer, I'll tell you that, but I'll certainly give it my best try. First, a little bit about our firm. Let me tell just a little bit about our history and where we've come from. Edward Jones offers financial services to individual investors, serious, long-term individual investors. That's it. We don't focus on the institutional market. We don't focus on merger and acquisition. We don't create product. We have no proprietary product or product manufacturing facilities. Missouri is our home state. St. Louis is our hometown, and we're proud of it. As a matter of fact, if you look back to when we were founded, it was 1922 when Edward D. Jones Sr. was treated very poorly by his brokerage firm employer at the time. He had found an underwriting and was not recognized nor compensated for having done so. So he quit. And he said, I can do this better. And he established his own firm. Now, his vision of the firm was significantly different than what has evolved over the years. His original vision was to have a very large boardroom operation in the largest cities in the United States. Obviously, the one in St. Louis being the first, but with aspirations then to open offices in Chicago, in New York, in Los Angeles, in Dallas. Well, that didn't work out quite that way. We did start with that typical boardroom operation in St. Louis. He operated that very successfully, actually, for about 20 years. Shortly after World War II, his son, Ted Jones, came back from the war. Mr. Jones desperately wanted him to be in the business, to join him in the family business. Ted loved the country, and he lived west of St. Louis in Williamsburg, about a 90-mile drive. And he commuted in every day, and he hated it. He didn't like going to St. Louis. He didn't like being in the big city. He didn't like working in the office. I don't think he really liked working for his dad that well. And Ted was a very independent guy. So what he decided to do was work in a little bit different way, but to do basically the work that he knew was important. Instead of driving into the office every day, he would come in on Mondays. He would figure out what was going on, what we had available, if there was an underwriting or a special offering or something like that that he needed to know about. But then the rest of the week, he wouldn't come back until Friday afternoon. And what he did with his days in between Monday and Friday was to drive through small towns in rural Missouri, introducing himself to individuals, offering exceptional service, and helping them to invest well. doing the work of the firm, but not doing it from a boardroom, not doing it over the phone, and most certainly not doing it from downtown St. Louis. Different technology at the time. You really could accumulate your orders and then casually drive to the big city and enter them all on Friday. Today, you'd get shot for doing so, if not arrested first. You've got to process that business in moments or you take enormous market risk. Well, in 1957, Ted had the pleasant task of offering a local stock issue that was coming out of the town of Mexico, Missouri, right down the road. It was actually an issue by a brick manufacturer. He went to Mexico. He began calling on people. He realized the size of the issue and the amount of hours in the day wouldn't allow him to get the job done. So he hired a fellow from there in town. His name was Zeke McIntyre. Zeke lived in Mexico. He knew everybody, and Ted hired him to help him sell the issue. As an interesting aside, and I am way off my script here, so I apologize that to the nice ladies that are forwarding my slides. Zeke had a business card that said if you want to buy them at the bottom and sell them at the peak, pick up the phone and call old Zeke. Now, don't you love that? I don't think that'd pass muster today. But we opened an office in Mexico in 1957. It was the first outside of St. Louis, and it was exceptionally successful. Zeke did well. The local service, the convenient location, the ability for people to sit down face-to-face with a financial advisor seemed to click. And Ted had found a market that no one else could see. Well, in the 60s, Ted started expanding the concept, started opening more offices in Missouri and actually in Illinois as well. And then he took over as managing partner. He started rapidly expanding the firm and then discovered in 1980 the firm had grown to a size where actually it was larger than he was going to be able to manage, and the potential was more than he was going to be able to realize. So he turned over the responsibility of the firm to John Bachman. We had 300 offices at that point in time. As was mentioned in the introduction, we have over 10,000 today. Well, starting in the 80s, we did something even a little more different. We began to move into cities and suburbs across the country. We had up until that point in time, including when I chose a town, Connorsville, Indiana, 20,000 people, county seat community, wonderful town, but it was the perfect Jones community, 20,000 people. We didn't dare go to the big cities because everybody else was there. Well, what we found out is because everybody else was in the big cities, they appreciated the service that we provided, and the difference was even more clear to the individuals that lived in the big towns than it was to the people who lived in small. Well, the business model proved itself. Clients are defined by their mindset, not by their address or their zip code, and people appreciated the access, the convenience, and the service. So the firm's growth continued, and we have become a multinational firm. We're not just in the United States. We're in Canada with about 650 financial advisors. We're actually in the UK, United Kingdom, and that's with a force today of about 275 financial advisors. We opened in Canada in 1994. We opened in the United Kingdom in 1998. Now, when I started in 1977, as was mentioned, we had 200 financial advisors. Kind of almost silly to think about us back then, as small as we were, as insignificant perhaps as we were. We thought we were a pretty big deal. Today, the more we grow, the more we feel like we need to grow. We count over 10,000 financial advisors in the United States alone. We actually ended last year with 12,200 financial advisors globally. If you look from 200 in 1977 to some 12,000 today, it's about 13% a year. Not all that remarkable. It is discipline, to be sure, and you have to execute on your strategies, but it most certainly has been possible. The home office, as I mentioned, is in St. Louis, but it's also in Phoenix, Arizona. It's also in Toronto, Canada, and we have another for the UK in London. Globally, again, 12,000 financial advisors, and yes, we are hiring today. Not very many firms are. We're looking for great people to share the opportunity with. It's extremely hard work. It's not easy to be a successful financial advisor. We've got an amazing training program. But if you have interest in doing something like that, then we'd be interested at least in chatting with you. We are not the largest firm if you count number of financial advisors. We're number 4, I think. It's hard to know with all the mergers and the acquisitions that have been going on this year. But if you count correctly, and there's only one way that we think that you should count, and that's count the number of individual office locations, we're number one. So you've got to be a little creative, but we can do that and actually propel ourselves to the front of the line. We have one financial advisor in each branch office, supported by a full-time service associate who can deliver on that promise of great personal service. We've got 550 offices in Missouri alone, 550 in the state alone. About 350 of those are in St. Louis. Now, two differences about Edward Jones that I want to highlight. First, we're a partnership. Almost all brokerage firms were partnerships a long, long time in the past. We're privately held. You cannot buy stock in our firm. Only the individuals, the men and the women who work at our firm, or perhaps work there and are now retired, can be owners of our firm. We have 11,000 limited partners. It's interesting to note that many of the financial services firms that were partnerships have all gone by the way. Now, some are still in business. To be sure, Merrill Lynch, still in business, now a subsidiary of Bank of America, but they went public in 1971, good long while ago. 1999, Goldman Sachs went public. They had a need for the capital and for the currency that their stock would provide them. They do an awful lot of trading activities, merger and acquisition work, and they needed access to the public markets. But when they went public, it left Edward Jones as the last large private partnership on Wall Street. I think that's just fine. I think that feels pretty good. Partnership is the basis not just of how we are organized legally, but it is the basis of our values and our culture, which is very, very important for us. It supports our business model in some very important ways. We work together. When you have individual financial advisors in each office, you have multiple offices in a community, we find that they work together. They will advertise together. They will hold seminars together. A veteran will train a newer financial advisor and volunteers their help to do so. It brings out the best in everybody. And we really firmly believe that owners act differently than employees. There's a significant difference. I like to say that we're responsible to our clients, but we're accountable to ourselves. And as a private firm, we're not subject to the pressures of that quarterly earnings announcement, the earnings guidance, the earnings announcement, the never-ending pressure for increasing earnings and dividends per share. Being private makes it possible to focus on the long term, which is a huge strategic advantage and a big relief for me. Managing for the short term is very difficult to do well. There's a second way that we're different, and that is we don't try to be everything to everybody. We don't compete for every client. We will not offer every investment. We have a unique, clear focus on our business, as I mentioned before. Every part of this is pointed in one direction, and that is serving the needs of the individual investor. That's it. It's not easy. It's very hard. We think we're good at it, but we're good at it in part because it's the only thing that we do. As I mentioned, we don't compete for every order. As a matter of fact, you can't buy a penny stock from us or enter an option trade or buy a commodity through us. We just don't offer those things. We also did not offer subprime investments. We did not offer auction rate securities. Again, with the focus on the individual investor, it just didn't seem like the right thing to do. Do not want to make it sound like we're perfect. We are most assuredly not. But we subscribe to a business philosophy that I think wears well over time and steers us around most of the big potholes. The focus on serving individual investors is why we have plans to continue to grow. There's individual investors that don't have access yet to a convenient Edward Jones location and don't have a relationship with an Edward Jones financial advisor. We're not there for them, and we want to fix that. We need to grow because there's people that are not having their needs met. We're identifying the markets and the areas in the country where they reside and where they're moving to, and that's where we are targeting our growth. Now let me transition. I'd like to comment on what's been happening in the economy, perhaps put it into perspective. I'm going to stay at a very high level. Number one, that's where I understand it. But number two, if we get into an awful lot of the detail, we will be here a lot, way past 4:45 this afternoon. But we're in a crisis, folks. We've got a mess. The credit markets have stopped working. Our individual investors are similar in some ways to almost all others. They are fearful. Now they're getting angry and impatient. They want this thing fixed, and we're listening to them. Let's talk a little bit about how we got where we are. financial crisis that's gripping the United States and the world, and this is not just a U.S.-centric issue, is basically, we believe, the outgrowth of speculation in real estate. And that speculation began many, many years ago, accelerated over the last decade. Now, some trace the beginnings of today's issues back to the Community Reinvestment Act. It was something put in place in the 70s. It was expanded dramatically in the 90s. Perhaps, I'm sure that contributed to it. It certainly made credit more available to some people who perhaps should not have received it. The scenario behind today's issues went something like this. Financing was made easily available, too easily available. It helped people buy homes that in some cases they could not afford. Simple as that. Their mortgages were then repackaged. Securitized is the word that we use for it. And then they were sold to other investors. Sophisticated securities were created, needlessly complex ones, by the way, that were designed to eliminate or to at least offset some of the risk involved, the default risk in those securities that were backed by the mortgages. And then those credit derivatives were sold to yet other investors. All of it led to a lot of speculation, most of this done with borrowed money. Not a good combination. When real estate did not fulfill the expectation, and this was key, there was an expectation that real estate would always hold its value and, in fact, would always appreciate. After all, it almost always had. Well, when it did not fulfill that promise, the realization occurred that the loans on the homes and the loans on the buildings and the securities that were based on them and the credit default swaps that had been sold related to their value were in trouble. And the whole thing started to sell off and tumble in on itself. Now, once property values began falling, the financial institutions that had poured their capital into real estate had very big problems. Their balance sheets deteriorated. You're reading a lot about this in the newspaper today. The credit markets froze up, and in fact, they stopped functioning altogether. That's serious. Now, you've read the headlines. One financial giant after another wrote off billions and billions of dollars, bad loans, troubled assets, many of which, not all of which, but many of which were mortgage-related. It's interesting to recount some of the proud firms that have been consumed by these issues. In March of last year, Bear Stearns nearly collapsed. J.P. Morgan bought most of it. In September, the whole thing really came to a crescendo. The government effectively nationalized Fannie Mae and Freddie Mac. They had to, agree with them or not. There wasn't much of a choice there. They were the mortgage companies that guaranteed $5 trillion of American mortgages. Next was Lehman Brothers, another investment banking giant that had expanded way beyond its traditional business. They filed for bankruptcy. The government allowed them to fail. Shortly after, Merrill Lynch, Merrill Lynch was the biggest presence, the largest firm, the best brand in our industry. And they had pursued a leadership role in subprime and credit default swap businesses and others. Found itself illiquid and failed. Had to be sold to Bank of America. U.S. government bailed out AIG, I guess after this week. It's now up to, $162 billion? Y'all own a little piece of that. You know that because it's your tax dollars and mine that are being used to rescue that firm. Morgan Stanley, Goldman Sachs, very interestingly, converted themselves from investment banks to regular old banks, commercial banks, in order to gain access to capital at the Federal Reserve at a lesser cost. Washington Mutual, the biggest remaining savings loan, failed. And the commercial paper market seized. The government announced a program to ensure money market fund balances. I mean, an amazing litany of issues that, in many cases, were addressed, at least on a short-term basis, by very, very quick analysis of the problems and equally quick solutions being put in place. Not long-term fixes, but at least something that kept the markets basically intact. Recently, the government is now stepping up to rescue Chrysler and to rescue GM and to rescue Citigroup. Too big to fail is something that we've heard an awful lot about. Now, the headlines, folks, are different in each crisis, dramatically different. But the result's the same. It's a bear market. It's a sell-off. In many cases, it's a recession. We have had 31 bear markets. You know what a bear market is. It's a sell-off of 20% or more. And most certainly we've had more this time. We're down about 50% right now. We've had 31 bear markets since 1900. 31! Yeah, people say, wow, this is the worst one I've ever seen. In many cases, it's the only one they've seen. So that perspective, I guess, is accurate. But you know, in addition to 31 bear markets, what we've had? We've had 31 recoveries. Yeah. Now, this one is pretty severe, but looks like bear market number 32. I believe it'll be followed by recovery number 32. A lot of lessons learned through all of this, and you really, really need to take a careful look when you go through these kinds of experiences. They're unbelievably valuable. If you don't learn from them, you will repeat many of them, and that will indeed be unfortunate. Let's talk about the lessons learned. Cash is king. You've heard people saying this. Leverage, excessive leverage leads to massive, massive problems. Borrowed money at some point needs to be repaid. Highly leveraged firms had the greatest potential for gain, but they also had the greatest potential for problems. And those with cash are doing just fine. Second lesson, financial markets are based on confidence. Well, you can say, no kidding. Yeah, and there's not a lot of confidence out there right now. It's been shattered. Today's ability to communicate the news is just unprecedented. We've all got our little BlackBerrys, PDAs, or cell phones where you can pull up the market. Stop it. You don't need to know. What difference? It might have been up or down at 1 o'clock. It doesn't matter where it is right now. But you know what? We've been conditioned to look, and we get afraid. Securities such as credit default swaps, needlessly complicated derivatives. Business school has a wonderful program, I understand, of being able to go and visit with Warren Buffett, who is an absolute hero of mine and a brilliant, brilliant investor, long-term value kind of oriented investment philosophy. He's referred to credit default swaps as weapons of mass destruction. And I think he's right. Nobody really understands these things. They were created by folks that back-tested them with the assumption that the past would look or would be repeated in the future. Didn't happen. Markets are global and interdependent. Yes, they are. We don't live in just the greatest economy in the world. It's one of several very large economies in the world. Our economy, our problems are not immune to the problems that face other countries. You know, it's so annoying. I mentioned this to a smaller group that I met with this afternoon. I get into the car in the morning, I back it out of the driveway, I turn on the radio, and instead of listening to the oldies station, I have it tuned to automatically go to Bloomberg News. I hate that. But why do I do it? I want to know what the Japanese market did. I want to know where the UK market is trading. It's not closed yet. At least not first thing in the morning. And I want to know what the S&P futures are. To tell me whether we're going to open up or down shouldn't be necessary. But you know what? The news is so transparent today and so immediately available. There's no hiding the good news, the bad news, or the rumors. Another lesson, successful firms will avoid the growth trap. The growth trap is something described by Michael Porter, who's a professor at Harvard. He wrote an article back in 1996 called What is Strategy? It's just a fascinating article. And I believe that not understanding the growth trap has proven to be a huge mistake that has destroyed some great institutions. Let me share a couple quotes out of that article. It really is interesting. On the growth trap, and I'll quote, "Among all other influences, the desire to grow has perhaps the most perverse effect on strategy. Trade-offs and limits appear to constrain growth. Eventually, pressures to grow lead managers to broaden their position by extending product lines, adding new features, imitating competitors, matching processes, even making acquisitions." What have we seen in the last year or two? All of those things. Yeah. Great example of this was also described a year ago in the January 22nd issue of the Wall Street Journal. It was an article called Paying for Goldman Envy. And Goldman was generally recognized at that point as performing remarkably well in many, many different areas of the market. Here's what the article said. Former Merrill boss Stan O'Neill would frequently berate his subordinates for not delivering Goldman-like results. Morgan Stanley's ex-second-in-command, Zoe Cruz, was constantly using Goldman as the yardstick for her firm's performance and driving a reckless desire to grow. 5 years ago, neither Citi nor Merrill were big players in the underwritings of subprime mortgage bonds or CDOs, collateralized debt obligations, or risky loans that were repackaged into all of those different levels of risk I talked about before. By 2006, they were at or near the top of the league in all of those markets. They reached for those marginal dollars of profit without the expertise to do so. Well, there's a lot of pressure to report quarterly earnings. Reaching for that marginal dollar profit feels good at the time. It is not a good strategy, and broadening your business beyond your areas of expertise is deadly. The same lesson was described a bit differently in an article in August this last year in Wall Street Journal. It said, sooner or later, Wall Street turns every good idea into a bad one. And I think they're probably right. There are some other lessons from 2008. Acquisition, consolidation, and innovation create institutions far more complex than our outdated regulatory environment could oversee. This is painful to see, but in fact, it is the case. I expect that we'll see regulatory re-regulation far in excess, perhaps, of what is needed, but it will be put in place in 2009. There will be an overreaction. It's typical. I think it can be expected. We need new regulation. Rating agencies have proven themselves to be unreliable. Again, you might think, boy, he's got a keen grasp of the obvious. Yes, I do. This one is very plain to see. We followed the rating decisions, assuming they had been made carefully, and they proved us to be wrong. The rating agencies can be helpful in determining what we make available to our clients, but they cannot be and will not be the only data point that we rely on. Transparency is critical. Transparency, you're hearing a lot about it. You're going to hear more as we go through the re-regulation of the investment markets and industry. If your success depends on secrecy, and it has been said, quoted in the newspapers, hedge fund managers, private equity managers saying, well, if I tell you what I'm doing, it won't be profitable anymore. If you can't tell me what you're doing, it probably isn't right. I believe that. Now, the old saying that sunlight is the best antiseptic, yeah, never been more true. You don't have to turn over your trading records every day to your competitors. You need to turn over your records to the regulators so that they can see if you're manipulating the market or abusing the markets to your advantage. That cannot be allowed. I believe the economy will recover, folks. It really will. It's going to take some time. Recovery is going to depend on three factors. Number one, stabilization of the financial system. It's what we're working on. This includes elimination or acquisition of some of the weakest institutions. You've seen banks fail, 25 last year, another 16 this year. It's what the Federal Reserve and the Treasury have been doing with all of that money. Second, reinstatement of credit flow to those who need it. We've got to get the credit markets working. Lots of good companies depend on credit to finance their daily operations. Nothing wrong with that. And today they don't have access to those markets. And it's going to take some time for the economy to correct all of the excesses. It took us a decade to get where we are, perhaps longer. It's not going to take us a decade to recover, but it's not going to be done tomorrow or next month either. Shared this with a small group earlier this afternoon. You know, we should have seen the bubble in the housing market and the real estate market when there was a show on TV called Flip This House. That shouldn't be possible. Buy a house today, do a little work to it, and sell it in a month for a lot more. Wrong. It's not that easy, and in fact, it was flawed. Well, as the government tries to facilitate the recovery, I hope it learns some lessons from the past, and there have been some. One lesson from the New Deal, and I know I'm going way back on this, but don't use a financial crisis as a pretext for your social agenda. We're seeing a little bit of this right now. We need to be careful. Both are important. I don't dispute that. But combining them can lead to a real mess. Works against both. Second, don't raise taxes in a downturn. There isn't a good example of when you've been able to tax your way out of a recession. I'd like someone to show me one. Politicians have tried it. It usually has the opposite effect of what we're actually trying to accomplish. So let's get to that second headline. What do we do now? Well, during extraordinary times, now more than ever, individual investors are seeking reliable advice. What works? What can I do to go forward? I know where I am today, but how do we make it better? I'd like to share the investment principles by which we advise our clients. They're pretty straightforward. We believe that the principles apply today every bit as much as they have in the past. Typically, our clients are individuals with very long-term goals to buy a house or put the kids through college or the grandkids, to plan for their retirement or to live a little better in retirement, perhaps to leave a legacy for the family and for the community. So even as a student, if you are one, you should begin the habit of saving regularly and investing for your future. The earlier you start, the more successful you will be. Now here's some general guidance. Number one, invest in quality. Invest in quality. Quality investments are those that have shown their ability to survive many, many business cycles, the ups and the downs. Nobody's going to ever repeal the business cycle, but invest in quality. These can be stocks, they can be bonds, they can be the mutual funds that buy them. Investors should look for stocks that pay dividends and offer the growth, the potential for the growth of dividends and a rising income over time. They should look for the funds that own those kinds of stocks because, again, over time, those investments will mitigate the rising cost of living. Nobody's concerned about inflation right now. Give it a year or two. We'll all be talking about inflation. In a market sell-off, folks, everything goes down. Quality recovers first and most. Second, diversify. We know all too well now that quality is no guarantee of attractive returns. I mean, everything went down. The most high-quality companies have sold off dramatically, 60, 70, 80%. Investors must decide how much money to put within various asset classes. This is important. You can't just buy stocks. You need to buy bonds. You need to have some cash. And the balance is critically important. The balance is determined by the nature of your investment objectives, what you're trying to accomplish, the amount of time that you've got to do so, and very importantly, on the amount of risk that you're willing to take in order to accomplish those objectives. An investor should look at the stocks and the bonds in their portfolio and ask one question today. If you had today's market value in cash instead of the stocks or the bonds, would you buy those same stocks or bonds? And if the answer is no, you need to move on. You need to sell them, as emotionally difficult as that is, and reposition into what is more appropriate. Investors today, I believe, have a much clearer understanding of the amount of risk they're willing to accept. We have asked, other brokerage firms have always asked, the questions to try to catalog the risk tolerance of the individual investor. It's an art, not a science. But if I asked you 2 years ago, could you live with a portfolio that went down 20% in a year? You'd probably say, yeah, I think so. But when it happens to you, your money, your account, it's a completely different deal. At that point, you don't just understand, you appreciate. And perhaps today we need to be revisiting, and all of you should, with your financial advisors or those that you rely on, your risk tolerance. If your investments are keeping you up at night, you probably own the wrong ones. Portfolio's got to be built on quality and diversification. And if you're investing for long-term growth, folks, we don't believe that you're properly diversified if you own anything less than 20 individual stocks. Now, if you can't afford to buy that many, then buy stocks a different way. Buy them through a mutual fund. By definition, you've got automatic diversification and a professional manager to go with it. If you're primarily focused on investing for income, you've still got to diversify, but diversification comes in a different size and shape than it does with stocks. A variety of issuers, a variety of maturities. Shorter maturity issues always pay less. They look less attractive. Longer term, pay higher rates. Higher rates also include more risk. You've got to diversify among issuers and maturities. Neither's perfect, but combined they can work very well together. As I said, investing for rising income involves greater risk. It's generally going to be produced by income-paying stocks, but it also provides the opportunity to earn higher returns next year when you're going to need a little more income because everything's going to cost just a bit more. Now, many investors, and I've heard this in the client appreciation events and groups that I've talked to here recently, are wondering how is it that they were a well-diversified portfolio of high-quality investments and they got hammered. Well, this sell-off has been broad across almost every industry and every asset class, but it relates to the third rule of successful investing, and that is quality and diversification only work over the long term. Yeah, now you might think, I haven't got that long to wait. Yes, in most cases you do. The next principle, invest for the long term. You've got to invest with patience. We've just completed the worst, this is interesting to note, the worst 10-year stock market since 1926. But losing money on a diversified portfolio of quality stock investments over a 10-year period is very unusual. If you look back at history, it's only happened 3 times since 1926. If you look at 10-year periods of time. So investing for the long term means at least 10 years, perhaps even longer. And history is no guarantee, but it tells us that bad times in the stock market are followed by good times in the stock market. Remember the 31 bear markets and 31 recoveries. Now let me expound on the 10-year period thing for just a second. There have only been 12 rolling 10-year periods since 1926, prior to the most recent one, when the total return on stocks is measured by the S&P 500, which is generally considered the broadest and perhaps truest measure of the overall market, when that return has been less than 6%. Well, in each of those 10-year periods, it was followed by a 10-year period of amazingly positive returns, and the average total return was 13% per year. So if you bailed out at the end, demoralized, depressed, unhappy, you never had a chance to participate in the recovery. Number 4, finally, recognize that investing isn't easy. It really isn't. The bull market makes everybody look brilliant. Bear market makes us all look like idiots. The truth lies somewhere in between. But to do it well over time on a consistent basis, we suspect you need a little bit of help. Now, you can't buy when you feel good. You can't sell when you feel bad. You'll get it 180 degrees from where you need it to be. It feels bad to buy right now, doesn't it? Folks, you got a 50% off sale out there in the markets. But it doesn't feel good to buy today. To stay the course, a successful investor needs discipline and patience and optimism. Anybody feeling disciplined, patient, and optimistic right now? No. When to invest well, you're going to have to put that hat on. Now, nobody can successfully figure out when to jump in and out of the market. We are not market timers. We are not fans of those who say that they are. It's interesting. If you miss just the 50 best days, biggest gains, 50 best days in the stock market over the last 30 years, that's not quite 2 days out of each year. It would have reduced your return from 12% if you had just bought and hold to nearly 0. Now, how are you going to miss just those 50? You can't do it. How are you going to be in the market for the biggest days if you're trying to jump in and out? Investors can only control 3 variables: the quality of the investments, the extent of the diversification that you build into your portfolio, and how long you hold onto them. That's it. So what specifically are our financial advisors telling Edward Jones clients right now? And then I'm going to go to your questions. Review your goals. They've probably changed since you put that portfolio together. It may need adjustment. Retired investors, you may need to cut your spending. Investors not yet retired might need to work just a little bit longer. It's a brutal fact, but it could be true. Review the asset allocation of your portfolio. It means the breakdown between the equities and the fixed income and the cash. might not be right, especially in light of your newfound appreciation for your risk aversion or tolerance. Investing too aggressively when the market's rising makes it more likely that investors will abandon their investment program when the market is falling. Yeah, feels good on the way up, though. Don't stretch for yield. High yield means higher risk. I mentioned that before. Increase the quality of your portfolio. Everything's down today. You can sell some of the less quality and buy more quality, oftentimes at an equal kind of a price, and quality will recover. Review your diversification, considering reduce your exposure to stocks and fixed income securities that represent more than 5% of your investable net worth. You've got to diversify. 5% is kind of the benchmark number there. And after all, we've seen that even the best of companies can have problems, so don't get loaded up in one. Capitalize on your losses. You can write some of them off against your income. You net them against your gains, and you can write off $3,000 against your income each year. Depending on your income, you may want to convert your traditional IRA to a Roth. You've got to discuss that with your financial advisor. Investors should reconsider their estate and review their will and their trust in the way that it was originally designed and written, so that you can be assured of still leaving the legacy that you desire. Lots of planning goes into being a successful long-term investor. In short, the advice is to continue to follow the investment principles, stick with quality, diversify, and be patient. And now is not the time to abandon a well-conceived investment strategy. If you've been doing well, don't depart from the rules that you know will work over the full market cycle. We know investors are discouraged, and they're upset, and they're angry. It's obvious. Absolutely. I'm angry too. But emotion should not drive your investment decisions, and panic has never been an effective investment strategy, ever. You also need to use the right tools for the job. If you're investing in very, very short maturities, money market funds, CDs, short treasuries, and whatnot, your yield is next to zero. You will not reach your long-term goals investing in just those investments. Right tools for the right job. Identify your objectives. We can help you identify what's going to get you there. We tell investors to plan for the future by looking ahead, not back. But it's so interesting to look back. Please don't read yesterday's headlines and invest based on them. That's history. It's what's already happened. It's not necessarily a good predictor of what's to come. I'll stop preaching. I'll stop talking. I would love to take your questions. Who would have a question or a comment? Yes, sir, all the way in the back.
Let me just
I'm
set
sorry.
the stage. Thank you, Mr. Weddle. Let's round of applause. We have time for questions and answers. We have microphones, and I'd ask that the questioners be concise and direct, and we'll give you a chance for a follow-up question if necessary. And we'll wrap up in 10 minutes or so, so stick with us. Who's got the first question? Where was it? Way in the back. Where's the second question so we can get the microphone to it now? Another question coming up?
Maybe after the
Yeah. If I were to begin investing tomorrow in the stock market, what are 3 companies that you would tell me to invest in?
Not going to answer that. How many stocks should you own if you're going to be effectively diversified? This is a quiz. 20. You can't buy 3. If you've got enough money to buy 3, then don't. Buy a mutual fund. I'm serious. Buy a no load, buy a load. Do whatever you want, but get diversification. You're going to have to depend on luck too much if you only buy 3, because I guarantee you probably 2 of them won't work out very well. You buy 20, you've got odds that are on your favor, so diversify. Look also, though, for quality, for companies that have stood the test of time, that have industry-leading positions, products that are name brand, reputations that are bulletproof. Those are the companies that represent quality, that are truly the blue chip. You take a lot of risk to invest in kind of startups and up-and-comers.
Okay. What was the best and worst investment you've made? Why'd you invest? And what'd you learn from each?
Oh, man. I'll tell you about one of the best investments I ever recommended, and it turned out to be one of the worst things I ever did. I recommended an individual stock to my mother-in-law, I'd been married about 2 years. She thought the brokers all had like inside track, right? You got stuff that other people don't know. So just I don't want to buy 20 stocks. I want to buy the one that's going to go up the most. I said, Patty, you can't do that. I don't know. She goes, yes, you do. What do you recommend? I've got enough money to buy one stock. I recommended a stock. It was called Varlin Incorporated. They remanufactured locomotives. Now, this was way back in about 1977 or 8. It doubled in 6 months. Worst thing that could have possibly happened, because we just set the expectation. When we sold it, she said, well, just do it again. Not good. Some of the worst investment decisions I've ever seen have been in my own account. I'll admit that. I don't own individual stocks today. Number one, it's not where I need to have my focus and spend my time and my attention. I can't buy stocks well. I can't sell stocks well. I love stocks. I love equity ownership, so I own it through mutual funds. And you've got to be careful on which one of the 7,000 of those funds that you buy. But some of the dumbest things I've ever seen happen in an account were in my own, because I was investing more on emotion than on the fact. I would never have recommended to a client what I put in my own account. Well, that probably should have been the acid test in terms of, hey, dummy, don't do it in yours either. And that kind of was what my wife said afterwards. But you've just got to be very, very careful. Again, if you stick with quality, you'll avoid almost every major problem.
Next question.
You mentioned regulation reform. What would be the number one regulation we need to reform or add that we don't currently have?
Yeah, the regulatory reform is urgently needed. The evolution of the financial services industry, the participants, has been dramatic over the last 10 to 20 years. Glass-Steagall went away. It allowed banks and brokers to kind of get in each other's business, and then we all got insurance and whatnot. Not necessarily bad. Bad, though, because there was no regulator that had overall responsibility, authority, and accountability for monitoring the activities of those very sophisticated, very large organizations. We need a systemic risk regulator. It's the buzzword right now in Washington, D.C. You'll read about that in the newspaper, but it is a regulator that doesn't exist today. It will have to be created, and it will have to have far broader, more extensive responsibility for regulating these very complex financial services firms. The old model of the securities regulator regulating the brokerage firm and the state-by-state insurance regulator regulating the insurance companies and the Fed or the bank regulators overseeing the banks doesn't work, because you got organizations that are all three. You've got to have a security or a regulator that has responsibility for regulating the overall risk that can occur only between, and oftentimes between, the interaction of the parts. The Congress is about to take this up. We're encouraging them heavily with great urgency to get this in place, because I think it's one of the basic items that needs to be established in order to return confidence, individual investor confidence in the markets and the way that they work. The other thing that's going to have to be done is that those entities that are outside the regulatory purview today, that are basically unregulated, the easiest example is a hedge fund, needs to be pulled into the regulatory environment. They cannot be allowed. They can impact the markets significantly, and if they have that ability, they need to be regulated as well. Yes?
At what percent should an investor keep in the market, and what percent should they keep in cash in the current market?
Question is, what percent should you have in cash, and what percent can you afford to have invested? You know, it's a very individual kind of an answer to your question. Depending upon your risk aversion, depending upon what you're trying to accomplish, you may be able to be more fully invested or less so. If you have less certainty about your expenses or your obligations and liabilities, you need to hold more cash. If you have a lot of certainty in terms of your expenses, then you can be more fully invested. It depends on who you are, your total portfolio, your situation, and really what you're trying to accomplish. I know I'm sidestepping, but there is no one right answer for the 300 people we've got in the room today. But it's a good question that needs to be discussed with a professional. Yes, sir.
What are your thoughts on mark-to-market accounting? Would you like to see it expanded?
Thoughts on mark-to-market accounting. What that means is banks today have assets on their balance sheets that are difficult to price. Mark-to-market accounting means or dictates that if you can't find a price for it, then basically write it down to zero. If you write assets down to zero and there's significant portions of your balance sheet and you're a bank, all of your ratios start to fail. You don't have the adequate capital to meet your requirements. Now that's an oversimplification. There's a quick fix. Don't mark them to market. Just say, the rule doesn't apply. That doesn't fix it. It addresses the issue on a short-term basis, perhaps, that will be implemented. We need to get the assets off the balance sheets, either get the markets functioning to where they can be priced and resold, or you've heard the bad bank thing talked about in the paper. The government has proposed that they create a bank that will buy these things. Again, they got to price them at something, buy them, hold them, repackage them, price them, and then resell them, perhaps for a profit or not. It would get cash on the bank's balance sheets and get the securities off. That's a better long-term solution, but we may not have a long-term to wait.
In the bad bank, that was what was done with the Resolution Trust Corporation, right? In effect?
Much the same way, yes.
5 years then, when we emerge from the crisis, where would you like to see
I would like to see mark-to-market unnecessary. Excuse me, it needs to be in place, but the discussion of whether it should be eliminated should be unnecessary, because the credit markets will be operating. Pricing mechanisms will allow us to understand what these things are worth. Look, they were mispriced from the get-go. Nobody understood the risk that a lot of these securities represented. So they were always mispriced. So even marking them to market, you were marking them to a price that probably wasn't right. Well, needlessly complex. Derivative securities have long tails on them. They're very difficult to manage and to price. We need to simplify. But you don't just, you can't solve the problem. You really don't solve anything by saying, well, we'll just change the rules and act like they don't exist. Even if you don't value them or you don't calculate your ratios saying that those bad assets are on your balance sheet, they're still there. We can ignore them for a while. We may have to. It's not the solution long term. And we'll recover in less than 5 years.
Next question?
Yes.
Mr. Weddle, you said that in the current economic environment, two things you should not do would be advance the social agenda or raise taxes. Seeing as the government now appears to be doing both, some would argue, does that mean that you believe the bottom is still a long way off? And if so, should potential investors, such as graduating students, stay away from investing?
Well, remember what's been proposed has not yet been enacted. Actually, good decision, I believe, allowing the treatment of dividends and capital gains to expire naturally instead of accelerating the expiration date. Actually, the proposal in terms of raising the marginal rate on dividends for high-income individuals, but not raising it to marginal income bracket levels, I think that's a win, actually. I think there's a danger to saying we're going to raise significantly the income taxes on the most successful people. A tax is actually a penalty for success, if you want to look at it that way. And successful people also create jobs in many cases, so there's a balancing act. It's also the high wage earners that are going to have to buck up here and pay some more to get us out of debt, and we're creating massive debt right now. We're all going to have to pay a little more. Can you tax your way out of a recession? I don't think so. So let's get the job creation going. Let's keep people in their houses. There's proposals that are going to stop the defaults from occurring. You're reading about it in the papers yesterday and today. They're getting the building blocks in place. And the proposals on the income tax, perhaps they're enacted, perhaps they're not. Interesting to see that the proposal to eliminate or to reduce the deductibility of mortgage interest and charitable contributions was out there for 24 hours, and Tim Geithner, our new Treasury Secretary, backed away from it, saying, that might not be a great idea. Thank you. They got a little bit of input, a little bit of feedback. We don't want to discourage charitable giving. Some magnificent organizations depend upon the generosity of many, and that generosity is incented by effective tax legislation. There's going to be a bargaining process. There's going to be a negotiating process. Again, I'll stand by the comment that I made. I think it's dangerous to mix the social agenda and the stimulus. The stimulus needs to be used in a very focused way to create jobs. People with jobs behave rationally. They pay their bills. People without jobs walk away from their obligations. They have to. They have no choice. So we've got to keep people working or get them back to work. And when you start using some of the stimulus dollars to accomplish your social agenda, I think you're watering down the ability of the stimulus to have the desired effect. I'm a very conservative guy. I've offended some of you, and I apologize. But I believe that to separate the two probably will allow both to be accomplished, but the more urgent need to be met first.
Good place to end.
Are we out of time?
No, that's
You've been very patient, and I thank you very much.
You didn't offend me. Yeah. Stay here. Yeah. Thank you, everyone, for these great questions. Before we end, let me thank everyone who contributed to the success of today's Scott CEO Forum. The staff of the Academic Support Center, we always appreciate their help. Members of our advancement office and our photographer, L.G. Patterson. We have a couple of appreciation gifts for Mr. Weddle. First, a plaque for his service, and it reads, with our college name, Robert J. Trulaske Sr., College of Business, University of Missouri, in appreciation to James D. Weddle, Thomas and Betty Scott, CEO Forum, March 5th, 2009. So, Mr. Weddle,
thank you very much. I appreciate that. Thank you.
We also have another gift. Has the WashU background, DePaul undergraduate, but I'll just say that it's a lot better day to wear this than wearing an Oklahoma cap. So, all right?
Thank you.
You bet. Mr. Weddle will be here a few more minutes before he has to leave. If anyone would like to talk with him one-on-one, come on down. We're going to try to squeeze in a few photos as well. You've been a great audience, as always. Thank you very much for coming. We are adjourned.